Have you ever entered a trade, and the moment you entered, price reversed, you buy, and suddenly the market drops? You sell, and suddenly the market pumps. At first it feels personal. It feels like the market is watching you. But the truth is simple. The market is not hunting you. The market is hunting liquidity.
Let's start with the most common beginner trap. Price is moving up. It approaches a previous high. Many traders see that high and think, if price breaks above this level, I will buy. At the same time, traders who are already selling have their stop losses above that same high. So above the high, there are breakout buy orders, stop losses, and emotional traders waiting to enter. That area becomes liquidity. Now price pushes above the high. The breakout traders enter, stop losses get triggered. The move looks strong. Everyone thinks price is going higher. But then, price rejects and drops back down. This is called a liquidity sweep. A liquidity sweep happens when price moves above a high, collects the orders in that area, and then reverses. This is why many beginner traders feel trapped. They are not entering before the move. They are entering where liquidity is being collected. They buy the breakout after the orders are already triggered. They enter late. And then price moves against them. The problem is not that the market is random. The problem is that the entry was too obvious. Now let's look at the opposite situation. Price is moving down. It approaches a previous low. Many traders see the low and think, if price breaks below this level, I will sell. At the same time, traders who are already buying have their stop losses below that low. So below the low, there are sell stop orders, stop losses, and breakout traders waiting to enter. That area becomes sell-side liquidity. Price breaks below the low. Late sellers enter. Stop losses are triggered. Liquidity is collected. Then price quickly moves back up. Again, beginners feel like the market is against them. But the market is not against them personally. They simply entered at the obvious place. And in trading, the obvious place is often the trap. This is why previous highs and previous lows matter so much. Above highs, we usually have buy-side liquidity. Below lows, we usually have sell-side liquidity. But here is the important part. A liquidity sweep alone is not enough to enter a trade. Do not see price sweep a high and instantly sell. Do not see price sweep a low and instantly buy. That is still guessing. You need confirmation. Confirmation means price gives you a reason to believe the market is actually shifting direction. For example, if price sweeps a high, then falls back below the level and breaks a recent low, that can show sellers are taking control. If price sweeps a low, then moves back above the level and breaks a recent high, that can show buyers are stepping in. This is where liquidity and market structure work together. So the next time price reverses right after you enter, don't just blame the market. Ask yourself, did I buy after buy-side liquidity was already taken? Did I sell after sell-side liquidity was already swept? Was I entering the move, or was I becoming the liquidity? Because in trading, the most obvious entry is often the trap. The breakout everyone sees, the breakdown everyone chases, that is usually where the market finds orders. And once you understand that, you stop reacting like the crowd. You start reading the chart differently. You start asking, where are the highs? Where are the lows? Where are the stop losses? Where is the trap? Remember this, the market is not hunting you personally. It is hunting liquidity. Learn to see liquidity, and you will never look at price the same way again. This is Professor Liquidity. Stay sharp, trade with logic, and remember, the crowd sees a breakout. We look for the trap.
If this lesson helped you see the trap before becoming the liquidity, hit the like button, subscribe to Professor Liquidity, and stay sharp. I'll see you in the next one.